Hello, everyone, and welcome to today's webinar, Country by Country Reporting, Implementation, and Risk Assessment Challenges. Before we get started, I would like to go over a few items so you know how to participate in today's event. We have taken a screenshot of your control panel that looks something like this in the top right-hand corner of your screen. When you join today's webinar, you selected to join either by phone call or computer audio. If for any reason you'd like to change your selection, you can do so by accessing your audio pane in your control panel. This webinar is being recorded, and you will receive a follow-up email within 24 to 48 hours with a link to view the recording of today's webinar. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of your control panel. You may send in your questions at any time. We will collect these, and if time allows, we'll address as many as we have time for. If your question isn't answered, we will follow up via email after today's webinar. I would now like to introduce today's moderator, Bobby Smith.
Thank you, Lori, and hello, everyone. Thank you for joining us today. I am an editor-author with the tax and accounting business of Thomson Reuters and with a focus on BEPS issues. Next slide, please. And here is our panel for today. We have Jeff Cazzo. Jeff is a senior solution consultant with the OneSource business of Thomson Reuters. In Jeff's current role as a senior solution consultant, he works closely with multinationals to understand their use case requirements and facilitate both customers and market requirements into the suite of solutions. We also have Jessica, and she is also an international tax managing editor author with the tax and accounting business of Thomson Reuters, also with a focus on BEPS issues. Jessica has over 8 years of international tax experience at Big Four firms, specializing in hedge funds, private equity funds, and corporations. And lastly, we have Kim. Kim is a principal in the International Tax Group at KPMG's Washington National Tax Office. Kim leads country-by-country reporting for KPMG's U.S. firm, in addition to co-leading the firm's inbound practice. Kim advises clients on inbound and outbound international tax planning, reporting, and controversy issues. Next slide, please. And so here is an agenda of the topics that we're going to cover today on country-by-country reporting. Not going to go through each one right now in the interest of time. Next slide, please. For most tax authorities, 2018 will be the first time that they receive information on large M&E groups with operations in their country, breaking down a group's revenues, profits, tax, and other attributes by tax jurisdiction. This will be a great opportunity for tax authorities to understand the structure of a group's businesses like never before. So Kim, can you lead us off on this discussion here and some general considerations on country-by-country reporting, including the questions that we have set out here?
Sure. And so like, all right, so, you know, we're kind of in the middle of the filing season, right? So the first filings have happened, the second wave of filings, and maybe, you know, even the third wave of filings have happened, but people are still struggling. And the folks that are struggling, not only the ones that have already filed, but the ones that are sitting there going, am I done yet? And what's going to happen next year? And am I going to be done next year? And then what's going to happen beyond that? They're asking questions that are going beyond just the kind of the physical, oh, how do I do the data pool? How do I do the mappings? What's going to happen? Like, how do I manipulate these numbers? Now they're starting to think about, what do these numbers mean, not only to us and, you know, what does this show the world, but how does this show the U.S. Maybe something different from some of its counterparts in the other jurisdictions? And am I going to get caught in the crosshairs when they start kind of arguing with each other as to what their fair share of tax revenues from me is? Because if that's what's going to happen, then, you know, pretty soon we can all guess that our fair share, the fair share is going to go up. Like, the level is going to go up, it's going to come out of our pockets. And so one of the questions, so a lot of these questions kind of have to go towards that at this point in history. And so if we go through them, one of the questions that comes up very, very often is, well, gee, we've kind of noticed that as we're going through our data mappings, that the U.S. rules are a little bit different from the other rules. A lot of folks notice this, in particular, trying to figure out, do I have to do secondary filings? Do I have to do surrogate filings? What's going on, especially as we move towards the end of the year and maybe not. We get all the QCAAs we want for the holidays, but and so they say, well, what's going to happen once I file the U.S. report, which does have some nuances to it that don't appear in other jurisdictions' rules. Will it get penalized? Like, what are they expecting? And the answer is, well, yes and no. Okay, so if you're making a U.S. filing, then you follow the U.S. rules, and then the fact that other jurisdictions don't have the same kinds of rules we have. So, for example, with respect to U.S. LLCs, under the very narrow circumstances, if you meet the requirements, you can report those as U.S. companies instead of stateless. Other jurisdictions don't have that. That is the kind of the number one thing that people kind of angst about, right? Am I going to get penalized by the other countries? The answer is no if you are filing in the United States. However, that answer kind of changes to yes if you end up having to file under a different jurisdiction's rules. So if you have to make a filing somewhere else, I would advise you to always talk to the folks in that jurisdiction, whoever the advisor's office is there. So, call up our French office or call up our Korean office and say, hey, what happens if I file a U.S. style report? They will almost certainly tell you, oh, well, everybody's based on the OECD template, so all is good if you follow the OECD template. That's not actually the question that you want to be asking, and it's not actually the answer that you need. The answer that you need is to the question of, yes, I get it. We're all looking at the same template, but we have very specific interpretations such as blah, right? And with that blah, go ahead and use the stateless versus U.S. characterization of U.S. LLCs. And then there's going to be a little moment of silence, and then they're going to say, oh, you know what? We think that you have to not do that. Don't do that in our jurisdiction. And that's pretty much the answer that you're going to get, but just double check just so that you can be absolutely sure, because as we move towards the end of the year, there may be a little bit of relief on that because we are kind of getting to towards the finish line on all of this, right? And so that's the answer to the question one. But when people go, all right, so if that's not a risk, what am I looking for? What are the data points that stick out that I am going to have to maybe explain and maybe kind of try to get ahead of, particularly if I'm looking at the possibility of Table 3 disclosures or other kinds of narrative that might soften the edges of these data points. Like, what am I looking for? So you're looking as you're kind of doing your last pass at things like, do I have lots of profits but not enough employees to really justify them? Why not? Because if that's what happens, and yes, we've seen this in certain circumstances. So, in the last few weeks, we've had like lots and lots of sales profits, but no employees, or lots and lots of services, even worse, like services profits, but no employees. What's that going to do? That's going to trigger questions about permanent establishment. Why don't you have employees? Are you sure you don't have employees? Are they someone else's employees? And are those someone else's, does that someone else who sends employees there, are they creating a permanent establishment for themselves so that we can scope out like kind of a bigger tax base in that jurisdiction? That kind of thing is the kind of thing that you want to be looking for as you're finalizing your numbers. So, big delta between revenue and profits before tax, where you don't have a lot of employees or tangible assets to explain the deductions. Okay, well, at that point, I think, based on the data and the data points that they've asked for, at that point, the tax authorities will be looking for deductions that are, sitting in financial instruments or in license payments, that kind of thing. And if they are intercompany, there's going to be pressure on that. So just look at your data with a fresh and critical eye to see, is there anything that just kind of sticks out as maybe not what a tax authority either expects or wants to see. And that's the kind of thing that you have to think about, is there a way to get ahead of that again, the sharp edge and maybe soften that a little bit. And so what are companies doing with Table 3? Are they using Table 3 to soften the sharp edges? Well, yeah, kind of. And so what I mean by that is, in the United States, there's a little bit of a philosophy of less is more. It's a little bit different from the Europeans that tend to be a little bit more voluminous on Table 3. But Table 3, as a general matter, is being used amongst my client base primarily to look at, hey, are there specific requirements? So the requirements of the source of data, I've got to tell them that. If your FX conversion rate isn't in accordance with GAAP principles, you got to disclose that. If you're taking any positions that are a little bit different from kind of what the straight and narrow is of the definitions given to you, then you're going to want to disclose that. But then strategically, there are some things that you might want to do to get ahead. So remember, we just said in this first bullet, okay, maybe you don't have to pay attention to the foreign rules. You can, and you're perfectly allowed to, and you really should be filing your CbC report under U.S. rules. But if there are material differences that give you a little bit of anxiety between what you would get on a U.S. report and what maybe you might get on a foreign report, maybe you think about disclosing that on Table 3 just to get ahead of the issues, or just to explain away problems so that they don't create false positives that'll trigger issues on your audit. So, for example, if you have a lot of let's say intercompany payments in a jurisdiction, but you're running a loss in the jurisdiction, automatically you think, oh geez, especially if there's services that would otherwise be cost plus, why am I running a loss? What's this going to do, right? But on the other hand, if you say, hey, you know what, that's a startup company, or the losses with respect to acquisition debt that we had acquired like years and years ago, or whatnot. And you get ahead of it, maybe you put a little bit of a Table 3 disclosure there because it's going to raise questions. If you've got an easy answer, go ahead and use Table 3 for the easy answer, right? Other recommended things you ought to be thinking about, well, what about head count? Is your head count kind of complicated? Do you want to explain whether you're, how you're converting part-time to full-time? Do you want to talk about how you're handling contractors? Not absolutely required, but something to think about, just because it'll ease the path of audit, and that's what we want to do, right? So people always ask us about stateless income disclosures because they are aware that the OECD focuses on stateless income a little too much in my mind, and they say, should we explain that? By and large, people do not explain that. I will say, though, on ours, because yes, KPMG has one, we did, because it was free and easy, right? It was a very, very simple way, because what happens in professional services is that a lot of the professional services firms conduct business through LLPs. That's just the way our industry is, and the LLPs in the United States and elsewhere are going to be stateless. So we have a lot of revenue that runs through the stateless line, and because those stateless entities are owned by individuals, they actually don't get duplicated anywhere, right? And so in a different industry, maybe it might look a little bit weird, and for a tax authority that isn't really thinking about it, maybe it causes a raised eyebrow, but it was super easy for us to go to Table 3 and say, hey, you know what, as is common in our industry, we run our professional services through partnerships and partnership format, and everything comes to an individual and individual partners returns, and we're paying taxes on a current basis, something like that. Again, super easy, fairly obvious, you would think, but gets ahead of any questions just in case. And then the other thing that you want to think about in terms of what you're saying is to be sure that you're saying kind of consistent things across your CbC, the rest of your BEPS 13 packages, other public disclosures. And hey, think about too, what are you saying to the IRS, for example, with respect to your Subpart F positions? Are you saying that you're manufacturing and therefore you deserve deferral? That would be great to be sure that your CbC report is consistent with that, and that those particular entities, it's just an example, are checked off as doing manufacturing, procurement if they are procuring, and that's, you know, a big part of your position with respect to raw materials, etc. But that kind of thing, those kinds of questions are really the questions that we're getting at this point. And Bobby, I hope that answers the concerns that you wanted on this slide to address.
Thank you, Kim. Next slide, please. And we haven't received any questions yet from the audience, but we do encourage any questions throughout. We'll try to answer as many as we can. So next slide that we're talking about now is for most tax authorities, to avoid local country-by-country report filing and to ensure that an M&E group is able to file a country-by-country report in just one jurisdiction, some jurisdictions allow for surrogate country-by-country report filings by a designated surrogate parent entity. The BEPS Action 13 final report does not make surrogate entity filings a requirement for jurisdictions that implement country-by-country reporting rules. In fact, the U.S. rules do not allow for surrogate country-by-country report filings for foreign parented groups. So Jessica, could you please walk us through some of these points here on the slide?
Sure. Thanks, Bobby. Hello, everyone. So this slide mainly focuses on secondary CbCR filing. So in general, you know, the ultimate parent entity of a multinational is responsible for filing the country-by-country report. However, there are cases that come up where, for some reason, the ultimate parent either is unable to file or there are no rules in place in that specific jurisdiction where the ultimate parent entity is a resident to file. There's no obligation to file. So in these cases, that's where secondary filing requirements come in. One of the secondary requirements, as Bobby and Kim mentioned, is the parent surrogate filing. Now, this is where, let's say, in a jurisdiction that does not have country-by-country reporting obligations in place for the 2016 fiscal year, let's say the multinational would still like to file a report. And so they can, in jurisdictions that allow for voluntary filing, this is called parent surrogate filing in these jurisdictions. And as Bobby mentioned, in the U.S., it's a little bit different, where U.S. entities are not allowed to act as surrogate entities for a foreign parented multinational group. So you have to look jurisdiction by jurisdiction. What are the requirements for surrogate filing? Which entities are allowed to act as surrogate filers? And if surrogate filing is allowed in a jurisdiction, in general, according to the OECD, there should not be any additional local filing obligations where the M&E has a constituent entity. Of course, there's always exceptions that come up, and you really want to just monitor jurisdiction by jurisdiction where your constituent entities are located. But the general rule is where you have a surrogate filer, you should not have additional local filing obligations. Now, in addition to the parent surrogate filing, you can also have your constituent entities file a country-by-country report locally in the jurisdiction where they are a resident. Now, this can come up in cases, let's say, where the ultimate parent entity is not required to file. The jurisdiction doesn't have rules in place requiring filing for the 2016 fiscal year, or there's no competent authority agreement between the constituent entity's jurisdiction and the ultimate parent's jurisdiction to actually exchange CbC reports. Another situation that arises where a constituent entity will file is where there's a so-called systemic failure by ultimate parent entities to actually exchange the reports. Now, in the U.S., the IRS has put on their website a table by jurisdiction for country-by-country reporting. Jurisdictions that have signed competent authority agreements with the U.S. or are in negotiations with the U.S. to exchange CbC reports. Now, we are telling people, if you have constituent entities in, a number of jurisdictions, check that table, check to see if, those jurisdictions are listed in the table. And if they're not listed, you may want to consider local filing in that jurisdiction. And even if your jurisdiction is listed, but it still says negotiating, not finalized, you may still want to consider local filing obligations just in case. Now, if your jurisdiction's not covered in the U.S. competent authority agreement table, you may want to look at other jurisdictions that are good jurisdictions for exchanging CbC reports. For instance, the Netherlands has an extensive network of competent authority agreements with other jurisdictions. So the Netherlands tends to be a good jurisdiction to use to exchange CbC reports if the U.S. is not an option. But remember, it's not just having a competent authority agreement in place. It has to be based on a double tax avoidance agreement as well. That would be the basis for the competent authority agreement. Now, also on this slide, we talk about potential country-by-country reporting notification amendments to, if you want to amend your notification if you've already, filed it. And there are jurisdictions that do allow amending CbCR notifications. Some of the jurisdictions include Brazil, where if you have a constituent entity, a Brazilian constituent entity of a foreign parented MNE, and they've already sent in their notification of who is the reporting entity, they are allowed to amend that notification. For instance, if there's no competent authority agreement between Brazil and the ultimate parent entity's jurisdiction, if that agreement's not in place by the end of this year, for instance, the Brazilian constituent entity can amend their 2016 CbCR notification. Cyprus is also an additional jurisdiction that entities are allowed to amend their CbCR notifications. Next slide, please. So this slide is just basically a snapshot of various penalties in certain jurisdictions for non-compliance with country-by-country reporting filings. We kind of listed some of the more, higher level penalties or more serious penalties. We didn't list every jurisdiction here. There are additional jurisdictions that have penalties for non-compliance, but in these jurisdictions, for instance, Australia, the monetary penalties are pretty significant, as are Luxembourg and the Netherlands. And surprisingly, some jurisdictions such as Malaysia and the Netherlands have instituted criminal penalties in addition to any civil penalties for noncompliance. And of course, a big penalty we mentioned at the bottom of the slide is reputational damage, which, companies don't want to be seen as not following up with local country, regulations and not complying with their country-by-country reporting requirements. And in Mexico, you can see loss of right to do business with government is a pretty severe penalty. So it's generally, I know certain clients have said, we're just going to maybe put away a reserve. We're not ready to file for the 2016 fiscal year. We don't have all our ducks in a row. So we're just going to put a reserve away, for any penalties that may arise. And I mean, in certain jurisdictions, that may be sufficient, but in like these specific jurisdictions, there is a real, significant penalty that could arise. And, you just want to focus on what jurisdictions you're operating in, where your constituent entities are based, what happens if you don't file in those jurisdictions. So that's just something you always want to consider. Don't just kind of wave it off as saying, oh, we'll just take the penalty this year. Well, the penalty can be pretty severe, as you can see. And with that, I'm going to hand it off and switch to the next slide.
Thank you, Jessica. And Kim, do you have anything to add on penalties other than what Jessica said?
Sure. So a lot of our companies, I think everybody kind of fantasized about, well, what happens if I just don't do it, right? And that's, I think, where a lot of this non-compliance penalty stuff arises, particularly the criminal stuff. But as we started getting into those nuances that we've kind of, talked about, then the question became, well, gee, am I going to get penalized for taking a position that other folks don't like. And I think, as we've said before, you know, you don't have to take a position just because the local rules say XYZ and the United States, you know, rules say ABC, right? You're not going to get penalized for that, but there are some things, right, where there are always positions, right? I mean, there's always going to be something, depending on your circumstances, where you're like, oh, I would kind of rather not, even though it's kind of straightforward to do it this way. I'd rather not necessarily do it that way. Is there a position that I can take, you know, that can reasonably take on this return for U.S. tax purposes? And is that, you know, even though it's kind of maybe reasonable and I have a return position under U.S. rules, like, I'm maybe stretching it a little bit, and is that going to be deemed to be non-compliance? Like, when does that kind of thing kick in? And we see this a lot. For example, like if there's a significant amount that folks don't want to put on the return, and so for example, that in the United States, right, we have this revenue definition, and the revenue definition is operating revenue, or it could, because the U.S. has left it open, include all other kinds of things, like other types of income that could kind of expand the number more towards gross income. And in Europe, they have, and really actually the rest of the world, they really have adopted more of a gross income approach. So if you're looking at a financial statement, you'd have to pick up revenue as well as other income amounts. Well, sometimes other income amounts can be big, like really big. And sometimes, right? Sometimes you're like, oh, even if I was doing kind of more of a gross income thing, especially say in year one, maybe in year two, all of a sudden you have an other income pickup that, let's say it's gain or something that you don't necessarily want to call attention to. And from time to time, we all have those issues. The question is, well, gee, what kind of non-compliance are we talking about? Like, is that where we get issues? That's where you've got to go, and you've got to look beyond just the monetary penalties, because as a general matter, if you've got a return position in the United States, you have to check to see what is the level of comfort. Do you need more likely than not? Do you need what in a different country to sustain the return position? But by and large, you're going to be okay. But what you need to ask is, number one, can I play around with Table 3 disclosures to kind of signal at some level as to what I've done with respect to the numbers, that maybe I signal and explain that it's not there and maybe why, and is that going to get me out of penalties? And in some countries the answer is yes. You can depending on the level of detail, you can take a Table 3 disclosure for missing items in your financial data. I would not necessarily advise you to take that approach generally, but you need to talk to your advisors. But that kind of thing can obviate some issues with respect to penalties based on the jurisdiction. But the other thing you have to think about is, well, are there things besides like imprisonment or monetary penalties that we're talking about? So, under 6501 in the United States, we have, for example, statute of limitations issues if there are gross omissions. That kind of dynamic is not very well crystallized, but that is something that is kind of a deal killer for a lot of companies and a lot of jurisdictions, and you are going to want to ask about that too. But and so, Bobby, did we have an audience question that we wanted to address while we were at it? Do we have time for that?
You, Kim, and thank you for the additional information on penalties. So the question we received was on the slide that you talked about, Kim. We talked about stateless income, and the question is, do the LLC stateless income issues also apply to S corps?
Yes, yes, they do. And so the way, as a general matter, the way we would approach reviewing, a prepared return is we would look for the items that we believe are the types of entities that we believe generally fall within the stateless category. So that would include your S corps, yes, your LLPs, your grantor trusts, I think like Lux SICAVs, KGs, Chinese business trusts, CVs, that kind of thing. And we've kind of have a little like laundry list in the back of our heads, and we go through and we look at your legal entity inventory and check to make sure that all of those things that we would normally see as stateless, in fact, land in stateless. And yes, the S corporations are on that list. Then we would go back and we would test the U.S. LLCs for the ownership rule to see whether they end up kicked onto the stateless list because they don't qualify for the U.S. status rule. But I would also say, by the way, the other way you ought to do that once you've checked your stuff that way is to go back to your stateless schedule and make sure that you, in just checking through the entities on there, that you're not seeing any blips, any surprises, because every now and then, particularly if you're asking foreign controllers to let you know whether they are fiscally transparent or not, they're getting a little bit mixed up is the tendency to and sometimes they answer the question under U.S. rules, and sometimes they answer the question under foreign rules, particularly if they're aware that there's check the box election in place. And so you may get a little bit of kind of a ripple effect through that, particularly in your entity mapping, and it may show up on your stateless lines. So double check, like kind of do the two-way check of your statelessness that way. This is my little public service announcement, but the short answer to the question is yes, the S corporations are going to be stateless, unfortunately.
Thank you, Kim. Next slide, please. The BEPS Action 13 recommendations say that tax administrations should take all reasonable steps to ensure that there is no public disclosure of confidential information, such as trade secrets contained in the CbCR report filing. Tax administrations are to also assure taxpayers that their country-by-country report information will remain confidential. In fact, the exchange agreements, whether modeled off of the OECD Multilateral Competent Authority Agreement or bilateral competent authority agreements on country-by-country report filings, require this confidentiality as well. However, there's been a growing trend to make certain types of country-by-country report information or all of the information public, starting with the EU. Kim, can you walk us through some of those developments?
Yep. Okay. So this is something that everybody's C-suite gets wigged out about, right? I mean, when we go and talk to audit committees, they kind of don't care about the private CbCR report because they're like, hey, you know, we've been doing 6038 compliance and information reporting for generations. So what's another form, right? I mean, it's just a question of, do I have to cut more budget to it? But the second they heard that there could be a public form of the CbCR report and it could be slapped up on the website for everyone to see, and for their competition to look at, and for their investors to peruse, they got wigged out. So this is something that if you're talking to your C-suite and you haven't already gotten questions on it, you're going to want to prepare yourself to get some questions. And so the EU, the EU, they have a little bit of a different philosophy. They really have much more of a, hey, shouldn't we all be good citizens of the world? Shouldn't we have tremendous transparency about everything? And they really use transparency kind of as a tool for helping to shape companies' behavior, actually everyone's behavior, but they like that, right? Because they're really kind of in the name and shame and therefore train people to behave correctly, companies to behave correctly. And so if and to the extent that they are, that they were aware going into kind of the Starbucks, hey, what's going on with that? Now they're hyper aware that they can use public pressure to help them, right? I mean, because no one has enough money to go after taxpayers and make them behave. They're really still playing catch up, and so this transparency within the BEPS Action 13 is to give them a leg up, kind of behind the scenes when they're playing catch up in audit. But this public stuff has nothing to do with tax, right? Because all the folks that are auditing you already have a copy to the extent that their governments negotiated or imposed rules to get a copy of your CbCR data. So what we're talking about is how they're getting ahead of the tax risk by effectively putting a chilling effect on people's appetites for engaging in what they think of as aggressive tax planning. And so we've got two things going on here. We've got, and and this is pretty much what this slide is about, right? So let's focus on the EU stuff. You've got the EU kind of trundling along. And the EU had originally said, and this has been going on for, I think, the better part of 2 years, and it's going to continue. The EU had said, hey, we think that this is a really good idea. Now, the OECD, of course, as Bobby pointed out, the OECD has been very, very concerned about keeping all of this confidential taxpayer information locked up and secret and protected. And all of a sudden, the EU comes out and says, no, you know what? We've changed our minds. We want to put it on the website. So there's a little bit of political wrangling, although I'm not sure the OECD has any power to stop the EU. It just doesn't. So the EU has, over the course of the last couple of years, come out with a number of different proposals, and some of them are very aggressive in terms of saying, hey, you know what? Forget this, 850 million US dollar or 750 million euro companies. Those are very big companies, and we care about those, but those will only result in like 2,000 of these reports in the EU, that if we required them to be published on the website, they would. 2,000. That's not enough. They believe in it so much that there's been kind of angsting about, should we drop these thresholds over time to make as many as 20,000 companies report a version of the CbCR report on the website. Now, over the course of time, like that pendulum has swung back to, well, okay, I tell you what, why don't we start off with the thought that only the big companies, so if you owe a CbCR report anyway to someone and you are operating in some format in the EU, maybe you guys will be the first kind of the pilot program for this public stuff, and that over the next 4 years we'll consider dropping the threshold once we get the pilot program launched, to see whether we want other additional types of companies, the smaller companies, to also have to disclose. Okay, so that's what's going on there. Now, in the EU kind of more broadly. Now, there have been a couple of jurisdictions, the UK and France, that have decided that, maybe we're going to try to get ahead of the curve because we think that it's such a great idea. We're going to go out on our own. So what happened in the UK is a little bit different than what happened in France. The UK Parliament said, yeah, we think this is a great idea. Tell you what, we're not going to wrangle over the details. We're going to give HMRC the ability to implement regulations without having to come back to Parliament to kind of talk about the weeds. We don't care about the weeds. You figure it out, and if and to the extent that you decide the public CbCR is good, you let us know, and you just put it in the books and it'll happen. So that's already in the UK. Have they done it yet? No, HMRC has not moved yet, but they can if they want to. The other thing that has happened is that in France, they decided, well, heck, if they're going to do that across the river, this is what we're going to do. We're going to say, you need to do a CbCR report. And they tried to pass a rule that said that, but the French Constitutional Court looked at it on a challenge and said, you know what, we think it's an unconstitutional taking of, expropriation of private information. So no, we're not going to make you do it. So the French proposal is gone. It's dead as a matter of French internal law. But what does that mean? That means that there really is, we can talk, and there has been talk about, what's going to happen in the EU. And there have been various straw polls that we've taken in our member offices. Do we have qualified majority vote? The EC Legal Commission, the legal service is saying, maybe it's unanimous vote. Okay, unanimous, qualified majority, whatnot. Maybe all that holds, maybe that doesn't. And you have to kind of see where those develop, just keep an eye on those developments and whether you think this is going to pass or whether not. It's probably not going to pass certainly for 2017. We don't have a lot of 2017 left. Maybe 2018. And the pundits are telling us that if it passes for 2018, it will probably be prospective. So maybe this is a 2019 issue. right? But what you have to think about as you're looking at all that is, gee, are there going to be countries like the UK or like France, can't do it now, but like France attempted to kind of get ahead of that curve and try to pass this before the EU does, because once the balloon pops, it's popped, right? So that's what you got to pay attention to, and that's kind of the synopsis of what, if you had to talk to the C-suite and tell them what was going on, that's what's going on. So the bottom of this slide is really just a question of, these developments, it's just kind of proposals in 2016. Like, don't pay attention to them for what does this bullet point say? Just think about the fact that it's not just Europe that every now and then decides that maybe transparency isn't the worst thing. The SEC is, of course, these are financial statements, right? They're very, very into transparency so that the investors know what's going on. And maybe it'll happen, maybe it won't. But even if you think about more recent developments for just think about things like tax reform, right? And think about, that excise tax with the ECI election, that had something to do with a look at foreign operating profits and a look at product lines. And, there have been, there are questions as to what my global leverage is, right? That kind of data and that kind of information may or may not, if those kinds of things ever came to pass, may or may not be based on the data on your CbCR report. But as we said before, whatever you say on your CbCR report, you're going to want to make sure is consistent with the positions that you're taking on other things, particularly other things that actually affect tax rate, right? And the amount of your tax liability on any given real return as opposed to an information return. So if you're looking at this slide, that's what I would take away from the EU, and that's what I would take away from the US, that even though we kind of think of this as an across the pond thing, maybe it won't stay across the pond entirely. All right. Back to you, Bobby.
Kim. Thank you, Kim. And while we have you still, we can go through another question relating to the slide that you discussed about earlier. A question was, how are corporations reporting information about joint ventures on their country-by-country report filings from your experience, Kim?
Okay, so with your joint ventures, what you're going to do is you're going to first look at what your consolidated financial statement treatment of them is. So if you're consolidating them for financial statement purposes, you're going to include them as a constituent entity, just like you would, for like a wholly owned CFC, right? They're going to be a member of your M&E group, and they're going to show up on your report, and all of the data, like I think 100% of the data ends up on the report. If they are consolidated, but they're at the 50-50 level, and you don't have greater than 50%, and they are a foreign entity, then you layer on the ownership rules of 60/38. And there you may get to the point where, because you both have to have membership within consolidated financial statement group and control for 60/38 purposes in order to trigger 60/38 information reporting requirements with respect to that entity, you may not need to include that entity on your report. But if that is the case, right, if that is the case, its financial data won't aggregate into the report, but dividends that you're paying from that entity into the group will be treated as unrelated revenues. Transactions that you engage in where members of the group are earning revenues, also unrelated. This does not, however, mean, by the way, that you're necessarily going to get out of treating them as related for your master file and local file purposes, because those, even though they're all in one BEPS Action 13, those are really based on transfer pricing kind of control relatedness issues. And as you know, the thresholds will be a little bit lower. And the final thing is that, real quick, that if you end up selling off your joint venture and your interest in the joint venture, and you are not including that entity within your group, then you will take the gain from the sale. you'll take the gain from the sale as other income, and it will be included in your revenue lines, right? And you'll presumably sell it to a third party, so it'll be unrelated. So hopefully that we can go on and on this, but hopefully that gives you enough. And if you need to ask more questions, go ahead and write us, and we can go into more detail if you want.
Thank you, Kim. Next slide, please. One of the conditions for receiving and using country-by-country reports is that a jurisdiction must have in place the necessary framework and infrastructure to ensure the appropriate use of country-by-country report information. Jeff, can you please discuss the meaning of appropriate use by the OECD in the country-by-country reporting context?
Right. Well, I mean, that's kind of the $60,000 question, right? I mean, what is appropriate when we think about it in this context? I mean, in all of our conversations, I think that we've had with the market, I mean, clearly taxpayers understand that none of this is going to be used as a basis for proposing changes. But the hard reality is that now all of a sudden we've introduced a tremendous amount more of information, about our entire profit stream that's out there for each taxpayer that can now be compared to everything else relative to our master file, our annual reports, our 10Ks. And so there's something that, to go back to Kim's discussion around public C-by-C reporting, and I believe it was actually a conference that I attended where Kim was a presenter. When we think about all of these areas for us to draw the connections between all this information that's out there, especially in light of this, everything that Kim mentioned around public C-by-C reporting, the narrative, right? As a taxpayer, we need to own kind of the narrative as it relates to our data, right? Not just from an individual taxpayer perspective, but how does my narrative fit into my industry? And this was a point that Kim shared, as a matter of fact, in a presentation where now our industry stories have to be somewhat aligned as well. So there's a lot to think about and a lot to consider with the prospect of public C-by-C reporting on the horizon, and the fact that we need to take all of these other variables into consideration. So what's appropriate use? I don't know that's something that we can accurately define, or that anybody, quite frankly, could accurately define. But the other element to what we're seeing, we are now seeing taxpayers analyze non-C-by-C required data as part of their country-by-country reports. So, things such as gross profit, not necessarily an area that is required for country-by-country reporting purposes, but maybe I have that listed somewhere, gross margins or gross profitability in my annual report. Well, now what we're beginning to see are ratios being created with gross profit number relative to how that might actually be shown within my country-by-country report, and how that could be analyzed or construed relative to, again, those other sources of data that are out there. Does it inherently suggest that there's a risk? I don't know. I probably not, but I think maybe in some cases it does, but I think what it does is it gives us kind of something else to think about with respect to how we can now connect the dots and information that exists out there simply outside of our country-by-country report, which really speaks to the statistical analysis I think that's being done. 2 years ago when we were talking with the market, one of the ratios that was brought up every conversation was maybe, profit to headcount or revenue to headcount. Well, now we're beginning to see taxpayers, still report that accurately and appropriately within their country-by-country report, but now maybe in their hip pocket have maybe payroll tax to revenue or payroll tax to profit, right? Because maybe there's a ratio that's going to look skewed because I don't have a lot of bodies in a specific jurisdiction, but from a risk or from a functional perspective, maybe that function or those individuals are very valuable. So in the event that I do get an IDR, a year from now, 3 years from now, about a specific ratio that's on a country-by-country report, I have information. I've thought through these scenarios that not just mitigate risk, but that just demonstrate the understanding of how this information can be interpreted. So So maybe to kind of close the loop, Bobby, to the initial question of what's appropriate use of C by C data. I mean, I think it's really just a function of being prepared for multiple eventualities, because we don't know exactly what could or how this data could be interpreted, but being prepared for that is really where we're beginning to see the market continue to evolve with the use of, not just statistical analyses, but getting into, more business analytics and, visualizations of that type of information, which, some of the more advanced conversations that we're having are certainly going in that direction.
Thank you, Jeff. Next slide, please. In late September of this year, the OECD released a handbook on effective tax risk assessment, which is supposed to assist countries in the effective use of country-by-country reports by incorporating them into the tax authority's risk assessment process. Among other things, the handbook discusses how country-by-country reports may be used by tax administration to risk assess M&E groups. And we're looking here at the 18 risk factors that the OECD identified in its handbook. So Jeff, can you walk us through these and talk about which ones, some of the ones that you think are more important and some that are more of a red herring?
Yeah, no, it's a good question. And I'll do so quickly just so we leave some time at the end for Q&A. And I know maybe some others on the panel have some thoughts about this as well. I think, first of all, when we look at this in terms of the risk handbook, again, are these immediate red flags? Are these things that we need to be immediately keeping us up at night? Maybe a couple of them are probably worth some good consideration, but I don't think any of them are, or not all of them are maybe show the level of sophistication that may need to be required from a taxpayer's perspective. I mean, when this first came out, we have a group of economists on our team, and they're answering questions, such as, well, if I look at number one, for example, does the size of my footprint indicate inherently that I have more risk associated to that? Well, no, not necessarily. And let's kind of dig a little bit deeper into what some of these, more intelligent types of factors might be. Is just the number two, the activities in the jurisdiction, are they limited to those that pose a risk? Well, who knows on the surface? I mean, do we need to do a little more digging in terms of ratio analysis and how we're depicting risk and really digging into, again, some of those other elements of our documentation, right? So the handbook emphasizes that, it doesn't provide the evidence of risk itself, but I think what these factors do is they really make us think about why are they in existence, right? So let's really think about why these are there. And I think that there's a couple of these that are probably a little bit more relevant than others. In our world, we deal a lot with kind of the corollary between what's happening in our local master file versus now with our client base in terms of what they're now producing in their country-by-country reports. So something like number 4 is incredibly important, right? So the results in the jurisdiction, do they deviate from your potential comparable? Certainly very straightforward and something that, clearly needs to tell a consistent story. Maybe number 11 is your IP ownership separated from relative activities within a group. Further to that, thinking through maybe a combination of those two when we look at maybe any royalty contracts that might exist in the context of IP. What's the conduct of those parties versus what's actually happening in terms of the economic analysis? Is that telling a consistent story? Because we haven't even talked about agreements yet, but that is certainly a key part of documentation, in this post-BEPS era here. We could look at a lot of these 8, jurisdictions with significant activities, but maybe high levels of profit or losses. If I'm running losses in a jurisdiction, but I'm showing multiple functions in my table 2, for example, or maybe I'm defining these functions as providing or taking entrepreneurial risk, does that make sense? I mean, so I think some of these are very, very common, but it's forcing us to really stop and think and say, well, why do these exist? What's the intent of some of these? And how can I begin thinking through not only the implications across my documentation and across the story that I'm telling, maybe even outside of transfer pricing? And I think that's the other message here that's becoming very clear to me, particularly in the last half of this year in our conversations with the market, is that clearly transfer pricing is touching other aspects of the business. it's touching finance, it's touching accounting, it's touching strategy, and it's getting on the radar now of how this story has implications to those other functions and impacting other stakeholders within each environment. And I think when we look at these, I think that each of these may mean different things to different taxpayers. But I think it's important to stop and take a moment to give a little pause to really digging in and thinking about why this list has been developed and where there might be some, exposure or maybe some inconsistency among everything that we've talked about here today. I think we could talk a lot more about that, but I just want to be conscious of time and see if anyone on the panel has anything to add or perhaps take any questions from the audience. Bobby, I'll leave it up to you.
Thank you, Jeff. And we do have one more question that we'll get through, but Kim, do you have anything to add on this slide, Jeff, other than what Jeff discussed?
Yeah, so we were at the OECD when they first kind of came up with the idea of this handbook. And I think, to be fair, it actually, as much as sometimes I make fun of this handbook, frankly, I think it was not the worst idea in the world because, you sit at the OECD and you have this thought that, these are actually very smart people, but not all of the tax jurisdictions are as sophisticated. They just don't have the experience, right? You can be really super, super smart, but if you don't have the experience in grubbing around in like large companies and trying to figure out what their sophisticated tax planning is, you're just going to be behind. And so kind of in the spirit of let's be sure that everyone has the best possible chance to use the data to best possible effect and avoid, unsupported adjustments and trouble and unauthorized uses, stuff like that. Let's write up these handbooks to help the jurisdictions that are less sophisticated figure it out so they can come up the learning curve a little bit more reliably, maybe a little bit more quickly. But if you look at this list, right, what does it tell you? I mean, as we've discussed, like we all started off with these visualization ratios to, we all looked at profits per person, effective tax rate, et cetera. That's pretty much fourth grade math, right? I mean, and we, but that's what we had at the time. And we said, well, why don't we just take our fourth grade math ratios and we're kind of scatter graph them in so we can figure out where we have outliers, and then outliers, you may want to have an explanation. And for a lot of us, that's where we spent a lot of time kind of in the early going doing our analysis. And we still look at it because it's a good thing to look at. You should always understand where you are. But then, the thought that fourth grade math ratio gets translated into a handbook for tax authorities. And the handbook for tax authorities says stuff like, hey, do you know how to calculate effective tax rate? Here's the formula. Is mind-boggling to me, because what does that mean? That means that, okay, couple of things. The handbooks really are there not as an expression of the most sophisticated uses for this data, but really as kind of a help and a resource for kind of the lowest common denominator, in some sense, amongst the tax authorities, right? But what else does it mean? If you look at this list, like some of these factors are much more helpful than other factors. Like look, for example, at the number 13, procurement entities and jurisdictions outside of key manufacturing locations. Okay, to me, that just shows kind of a misunderstanding of commercial reality, right? I mean, bananas are where bananas are. Gold is where gold is. Coal is where coal is. I mean, you're going to have procurement sometimes in places that you just don't manufacture, and sometimes that's also just not going to be where you're selling stuff, and that's just the commercial reality of it. So I'm not really sure why that's there. But then I look at things like, okay, information on the group CbCR report does not correspond with stuff provided by the constituent entity, either, CbCR reports from other years or other types of reports. That's actually pretty smart, right? And so there's a very, very wide range of these risk factors on this page. And what does that mean? Well, that means that some of these things are not very helpful. And if that's the case, and if the tax jurisdictions that are struggling to come up the learning curve really want this to generate more tax revenue, it's not going to help them. And so what that means is you think about the fact that the OECD has left open in 2020 the idea that they're going to renegotiate, they're going to reissue instructions, and they're going to reformulate the information requests they want on the CbCR report. That's almost certainly going to have to happen because this lift is not going to get those tax authorities to where they want to go. And they're not going to say, oh, well, then we're just done. Let's just pitch it. Or let's scale down the information we're looking for. No, they're going to ask for more. So I think that's what's in our future.
Thank you, Kim. And we have time just to answer the last question that we received from the audience. And the question had to do about data sources for compiling a CbC report. So, Kim, from your experiences, what are some of your clients using as a data source for situations where if they use the year-end reports, they use for year-end consolidations, the amounts in their consolidations can vary. So what are some of the sources in those instances that you've seen customers use for a CbC report?
I mean, honestly, so the vast majority of my clients use US GAAP. And then what they do is they live with the fact that once you close the books for your consolidated financial statement purposes, you're always going to continue to move towards, whatever's going on in local country, for book purposes, as well as local country for tax purposes. And you're always going to say, as you move towards actually finalizing those later reports, gee, I could have gotten a little bit more exact, right? But here's the thing, right? Just like your consolidated financial statement, at some point you got to call it a day. And then just like your financial statement, if you have adjustments, true ups, other allocations that end up affecting the numbers after you've closed the books and after you finalize the report, our approach is you take it, you roll it into the next year, as long as it's not material. If it's material, perhaps you roll it into the next year, but you use a Table 3 disclosure to signal what has happened, right? And so, you think, for example, like just your basic true ups. You close the books, you look at the commercial realities, you go, hey, we need a true up, let's do it in the next year. It then hits your books in the next year, your consolidated financial statement. So it'll show up in next year's report. Now that means that last year's true up shows up in this year's report, so you don't have, some weird little amounts falling off, but that's the way I would handle that. And then if you had certain things like branches or whatnot that you just don't break out normally for consolidated financial statement purposes, and you just don't have separate trial balances for them, you can use things like your management reports. Don't see a lot of that, but you can, and this is fairly common, especially for branches, you can use your income tax data. You just have to be sure to disclose the fact that you have multiple sources of data. All right.
Thank you, Kim. Next slide, please. And so this concludes our webcast today, and we have a poll question. If any of you would like more information about any of our Thomson Reuters tax offerings, you can select the options now, and we have answered all the questions that we've received, but if there's any additional questions, please don't hesitate to contact us. Thank you for attending.
Thank you very much.
Thank you.
Bye.